fight against climate change, Bloomberg Green has you covered.
New order placed to sell short at 120, 28.5. Euro against United States dollar.
At some point this year.
There is still a lot of scope for scarring in the labor market.
What we have, though, is a very big cushion that's been building in excess savings.
The virus dictated the downturn, and it will dictate the pace and the shape of the recovery as well.
A lot of the U.S. stimulus actually isn't stimulus at all. It's an antidepressant.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a simulcast. It's a Monday in New York, snowy New York as well. We welcome all of you across this nation on Bloomberg Radio, on Bloomberg Television as well. Lots of different story threads in this hour and in moments. We're really going to dig into the government, inflation, interest rate dynamic. We do that with futures up 12 and yes, yields higher as well. Bitcoin on it. John, just between my fourth cup of coffee, Bitcoin went 40 to 43,000. We could have 50,000 by when we're done speaking with Rosenberg.
Tesla getting involved, Tom. Cash management, maybe transactions as well at some point in the future. Yeah. And I think institutional buy-in is really important. It's what the bulls have been waiting for. They got a taste of that this morning.
Bitcoin up 15%, up 5,700. Now, John, let's get back on the script right now. It's really important to set up the guests for the hour where the script is not so much higher interest rate, but the speed of higher interest rates.
119.81, that's your number, Tom. Post-pandemic high, US 10-year Treasury yield, and it happened this morning. Chairman Powell speaks on Wednesday. I wonder if he carries on giving the green light for what we're seeing at the long end of the curve. 120, maybe that's not a problem. When does it become one?
Absolutely nailed it, John. And I've said this and I've said it again, and we've observed this from time to time. It's not only a speech that someone gives, but it's a whisper, a line here, and then somebody else, a whisper and a line there. You wonder how many whispers it will take to get some form of what I'll call Fed angst.
Keep hearing that policy is in a good place.
Yeah.
Maybe that's the line they keep to, Tom, but at some point that...
Short position open on euro at 120, 28.5.
Report, and that's a huge deal for Washington.
Yeah, and it raises this question, especially for the Federal Reserve. Is their allowance of asset prices to continue to go up, despite some of the concerns about froth and the lack of perhaps corresponding fundamental data? Is it actually helping the employment picture, right? Is it getting them closer to that goal? And it sort of goes to this idea, if we have faster inflation expectations at a time when we also have asset prices that are going up because you're not seeing the commensurate rise in Treasury yields, at one point will Federal Reserve officials get uncomfortable, Tom?
I want to get the data out of the way. It's correlated, everything but dollar really moving. And again, Bitcoin up 15%, 43,400, almost making it out to a 44,000 level. Futures up 13, Dow futures up 129. VIX doesn't give me too much information yet, 21.25 in the VIX. John just dropped through the bond market, 1.18% on the 10-year. And again, currencies, John, I mean, currencies aren't giving me much love this morning.
Well, I will say, Tom, let's build on this. I think what we're seeing play out, particularly in the last couple of weeks, is a US bias that's returned to this market.
Yes.
A focus on the fiscal plan that's bigger than anything we're seeing anywhere else. A focus on the vaccine rollout that I think the average daily rate over the last 7 days is getting closer to 1.5 million, the president's updated target. And a lot of people focusing back to the benefits of staying US-centric, so to speak, Tom. When we finished last year, we were talking about EM, maybe throw in some Europe. I don't hear many people throwing in some Europe over the last month.
Yeah, finally a pullback, John, in Bitcoin. We're from 44,000 down to 42,004. We'll watch that through the day. It's sort of like it's like a GameStop thing. GameStop, I saw at a 70 level.
We'll get some nice emails shortly comparing Bitcoin to GameStop.
Thank you. Right now, partitioning force inflation is a gentleman who's done that best. He's in my book from years ago, David Rosenberg, Rosenberg Research, and we're thrilled he could join us today. David, when you partition our present inflation and our expectations of inflation, what do you see?
Well, look, what we see is the break-even levels in the 10-year Treasury, getting as high, as they were practically, getting to the peak of the last cycle. So, we're already well above 2%. And the market is pricing in, not just a significant economic recovery, but alongside that, a closing of the output gap earlier than expected. And these inflation expectations, I mean, they've caught me by surprise how quickly the market is priced in an inflation cycle so quickly. I think it's way overdone. But, you know, the big question isn't so much the $1.9 trillion.
Right.
It's really ultimately how much of that $1.9 trillion filters through into the economy. And I would have thought, actually, that the markets would have recognized the survey that the New York Fed did a little while ago following the CARES Act that found that only 29% of that stimulus found its way into the economy. You know, the rest went into savings, I guess you could say, in the Bitcoin and the GameStop and the stock market.
Yes,
That's
I
part of
did.
savings. The rest went into debt pay down. Like, what I can't correlate is this in terms of the market mindset. How are we going to get inflation as the household sector is deleveraging, unless the market thinks it's temporary?
Well, David,
household demand for bank credit is running negative 3% year over year. Negative 3.
Okay,
Households are paying down debt, and people think that's going to be inflationary.
You're taking a different tack. Can you buy bill notes and bonds today? Can you buy today for price up, yield lower?
Well, I think we're heading into a very attractive buying opportunity at the long end of the curve. I mean, if you're bullish on bonds, I'd be heading towards the 30-year, which, as you said, touched 2% today. The bottom line here is that the Fed is not going to be tightening policy for a long period of time, so there's no risk that the cost to carry is going to go up. The big debate is really is about inflation. But you got a market right now that's priced for inflation heading to the peak we had the last cycle, core inflation. And I think that's going to still be very difficult to achieve, even with the fiscal stimulus.
David, let's build on this. When we're talking about inflation, as you correctly point out, we're talking about market-based inflation expectations. How useful are they, David? How useful have they ever been, given where we are right now? How do you move 10-year inflation expectations based on what's happened in the last couple of weeks?
Well, look, the biggest correlation between the break-evens is with the CRB index. And of course, that's real-time data. What people don't see is that the biggest component of the CPI and core CPI is rents. And vacancy rates are going up, and rental inflation is melting, and that's going to be dominating. But the rental data don't come out as quickly on your Bloomberg terminal as the CRB index. And we have a commodity boom going on. But we had 4 or 5 of these commodity cycles just in the previous 10 years. And that cycle from 2009 to 2019, we had 4 or 5 incredible, they look like sine waves. And people get caught offside because they believe, oh, we're going to get inflation's around the corner. And then what was the dominant feature of the last cycle? Did we get cyclical inflation? Yes, we got some of it. But the bigger picture is that from 2009 to 2019, despite all the gargantuan fiscal stimulus we had and all the monetary stimulus we had and a quintupling of the stock market, the peak in core inflation last cycle was 2.4%. To me, the big picture is that you got to go back a century to find the last time core inflation peaked at such a low level. And we're getting to the break-evens heading back to that right now. So I think that's a great buying opportunity. The market right now is pricing in peak core inflation from the last cycle when the unemployment rate was 3.5%, not 6.3%. So to me, this is a great opportunity to get back into the long end of the curve.
David, to build on what John was talking about, there's a difference between inflation expectations and actual belief in inflation that's being borne out throughout markets. How consistent is the reflation trade throughout all asset classes, or is it mostly tied to break-evens and a specific subset of the market?
Well, look, I think that you're seeing it across, a broad array of asset classes. I mean, you've got the reflation, inflation trade in small cap stocks. You're seeing it in commodities. You're seeing it in how value has outperformed growth for the better part of the past few months. So it's not just in the bond market. The inflation expectations, and I've only been fielding calls now in the past couple of weeks over whether the inflation story is going to be the real story. I think it's to me it's a head fake. I think that the surprise will be that the inflation doesn't come back as quickly as people think, but it's really endemic across almost every asset class you're seeing right now.
Really looking forward to getting you back, David. Always enjoy catching up. Thanks for being with us this morning. David Rosenberg there of Rosenberg Research. In your market right now, market-based inflation expectations are building. Tom, the cyclical trade is back on. The reflation trade is back on after stalling a little bit into the new year. The question you have to ask from a market's perspective, what are the sources of upside surprises from here on out, given what we're pricing in before we even reopen?
Well, yeah, and again, it's a linear function. I want to make clear, folks, inflation expectations, without question, have a certain oomph to them as well. But John, you know, you've got a consensus view, and then you've got 8 flavors. Oh, wait a minute, it's not going to happen. And clearly, Chairman Powell is in the Rosenberg camp, where he just doesn't buy the immediate urge to be fearful.
Well, I think the Fed, Tom and Lisa, you'd agree, just willing to look through this and willing to look through it for a while.
Yeah, although there is a concern. If David is right, if inflation expectations are too high, what does that mean for broader markets, given how much of a consensus the reflation trade has really become? And, you know, you have to think, added to his argument, is the amount of debt that we have incurred, not only on a national level, but also on a corporate level, John. I mean, that's a dampening factor for growth going forward.
Lisa, you know how this works. It's about market biases and just perception. Yields up right now, good thing. Yields down right now, good thing. Good thing. Good thing.
Well, look,
that's how this market sees things right now.
And right now, JP Morgan did a correlation showing that when bond yields rose, stocks really have been unfazed. So it really has been a solidly good thing and not necessarily a headwind. But at a certain point, John, you have to think, when are we going to actually see that consequences of this reflation? At what point will the proof have to come from something substantive rather than hopes?
Do you like that? I got that from Tom. Hand actions on radio, Tom.
It works
up,
good.
Thing.
Yeah.
Down.
It works good.
Thing. Do you
Radio
like that?
loves it. Yeah.
I love.
We're good at that. I like.
Hand
I was doing that deliberately to get you to do it as well.
Drive careful out there. We should say drive careful out there on radio.
I'm placing a stop on profit for euro at 120.26.5. Just right here. Okay. The stop on profit.
You know, he gets down to -5.
It was 1920.
It's like a beginning.
1922. I remember it well.
Oh, my goodness. Tom, you'll do your John afterwards.
-21, Plymouth, New Hampshire, coldest ever.
This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Treasury Secretary Janet Yellen predicts the U.S. can return to full employment next year, but that's only if it enacts a strong enough coronavirus stimulus package like the one proposed by President Biden. Yellen told CBS the job market is in a deep hole. Republicans have complained that the president's plan is just too expensive. President Biden promises a different kind of relationship with China's Xi Jinping than Donald Trump had. The president told CBS News there will be competition but not conflict between the two nations. He said there's no particular reason why he hasn't spoken with Xi yet. Bitcoin rose to a record price of more than $43,000 today after Tesla said it had invested $1.5 billion in the world's largest cryptocurrency. In a filing, the electric car maker said it may acquire and hold digital assets from time to time. Tesla also says it expects to begin accepting Bitcoin as a form of payment in the near future. And former U.S. Secretary of State George Shultz has died. Shultz led Cold War diplomacy under Ronald Reagan for more than 6 years and frequently clashed with more ideological members of the administration. Before that, the Ivy League-educated economist was Labor Secretary and Treasury Secretary under Richard Nixon. George Shultz was 100 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're currently expecting the first quarter of this year to look pretty much like the fourth quarter of last year. So we haven't really seen, or we're not expecting to see much sequential improvement in that period. But hopefully, as we get into the summer and beyond, we start seeing demand rebound.
What a tough time to be an airline. That was Robin Hayes, JetBlue's Airways CEO from New York this morning. Good morning, Tom Keene. A little bit later this year, JetBlue, they're going to go from the United States into London. What a time to launch that.
Yeah, they're going to do the Mint thing in London. I haven't really researched it, John, but I'm crushed that they gave up the 747 on British Airways. To be honest about it, but JetBlue's being really entrepreneurial there. But you nailed it last week, John. The airline recovery is just not happening.
Tom, when it comes to the sequencing of this reopening, it's shifted in the last month. Travel and international travel won't be opening for a long time.
I mean, to be honest, folks, John lived this down at Capri and Naples, and then you went over to Miami and Key West. And, John, the fact is internationally, it's not working.
Do you want me to reply to that? Am I responding?
No.
I'm letting that go.
Let's talk about the gas that these planes use, Tom.
Yeah, let's talk that nicely. So you nailed that, Segui.
The adults in the room.
On radio and TV,
room.
the grown-up did the Segui well. Futures up 14. We're watching Bitcoin 43,000. Amrita Sen is a joy to speak to with energy aspects. What she does better maybe than anybody out there is the elasticity, the responsiveness of supply and demand worldwide. She joins us this morning. Amrita Sen, I think you nail it with demand elasticity being an absolute mystery. How much of a mystery is it right now?
Oh, it continues to be a mystery. I don't think COVID has really helped the situation because, even when you had 90% of the world's manufacturing down or industrial production shut in, this was around March, April last year, oil demand only fell by 20%. It does show you how inelastic oil demand is. Right now, globally, oil demand is down about 5 million barrels per day year on year, which again, given the scale of relative lockdowns that we're still talking about, even in places like China, it is doing very, very well. I think the cold weather has also really helped. We've seen LNG prices in Asia hit record highs, and as a result, a lot of power plants there have switched to liquids, so fuel oil, LPG. that's been boosting oil as well. And now, of course, in Europe and US, you've also had a cold blast. So there's definitely support for heating fuels. That's potentially masking some of the weakness elsewhere. Like, you guys just talked about airlines. Jet fuel demand isn't recovering anytime soon. But I do think the colder weather has helped at least mask part of that weakness.
That's the demand side. Then there's also the supply side, the idea that OPEC Plus has maintained certain output cuts and that shale producers in the United States are actually producing almost a fifth less oil than they were, say, a year ago or, ahead of the pandemic. How high do oil prices get before all of that supply starts flooding online?
I think that's the million-dollar question right now. I think you're exactly right. Supply has been a very critical factor, and I think full marks to OPEC for how they've handled the market. This is very much their achievement, and they will take a lot of credit for this. Saudi Arabia in particular coming in with that 1 million barrels per day of voluntary cuts. They will start bringing that back from April onwards, but to your point, shale production, we don't think is going to go back to the 2019, the pre-COVID levels anytime soon, if ever, because they are more focused on discipline or like shareholder returns right now. I think in terms of oil prices, part of the problem is that the market can see this rebound in demand coming and supplies remaining tight, exactly what we're talking about right now, but we aren't really going to see the actual demand recovery till Q2, potentially even the second half of the year. But this is a futures market. We always discount stuff that's going to happen in the future now. That's why prices are rallying right now. Should prices today be $60? No, but we're trading April futures. And yes, things will sequentially get better. Remember, we've also got a very, very easy monetary policy, so much liquidity in the system. We've always called for $80 plus oil in 2022. Maybe that is $100 now, given how much liquidity there is in the system. I wouldn't rule that out.
We've been talking, Amrita, this whole program about how people are doubling down on this reflation trade, the recovery trade. And you do have some naysayers, David Rosenberg among them, and also Mike Mueller of VTOL, of the Asian operations. And he said over the weekend, the market is getting ahead of itself when it talks about oil prices going much higher from here. Do you agree?
I do think if you look at prompt fundamentals, yes, the market has gotten ahead of itself because right now demand is still relatively weak. It is going to get better. But again, this is a reflation trade. People are not going to wait for the event to happen to position. Why not position now if airlines will reopen, whenever that is? If not Q2, it will be Q3 or Q4. And I think that is part of the problem. You've seen this across asset classes, right? That the reflation trade, to your point, is very much in vogue. However, above $60, there will be headwinds from supply. Yes, U.S. production may not go back to 2019 levels, but it will start to rise. OPEC compliance might start to slip a little bit as well. So yes, I don't think this is going to be a straight line higher. We are also very cautious around the prompt. There's still a lot of unsold barrels in West Africa, for instance. Yeah. But it doesn't take away from the fact that the second half of the year does look much, much healthier in terms of demand.
Set the scene. $80 to $100 crude next year, second year of the Biden presidency. Tom Keene, it was Neil Dutter of Renaissance Macro last week who I think nailed it. Park the politics. Get rid of the politics when you start to make market calls. Well, because if you made a market call based on the politics, you wouldn't be at 80 to 100 on crude.
I mean, Amrita, frame this out. There's a trading range 70 to 80. No one believes in that. And then as John mentions, there's a migration back to 100. No one believes in that. How likely is it?
Look, that's an outside chance. I don't think the 100 is a base case at all. For us, the base case has always been around $80 next year for the simple reason that A, demand is going to go back to pre-COVID levels. B, we've even got Iran coming back. We've just put out a note saying Iranian production will probably come back by more in the second half of the year. We've always been very clear on the timeline that it's not going to come back before June. But with the Biden presidency, or administration rather, engaging or likely to engage with Iran, volumes will start to come back. But then once Iran is back, there's very little spare capacity in the system. OPEC will continue to bring oil back to the market. But non-OPEC supplies, which nobody talks about, there's no investment. Everybody is going after net zero. Everybody wants to be in the green, or has to be guided by the green agenda. If there's no investment in the upstream, where is the marginal barrel of supply going to come from once OPEC has exhausted whatever it can bring on to meet the increase in demand? That's the question for next year.
And Rita, always great to catch up. Come back soon.
Fabulous.
And Rita Sen of Energy Aspects there on the crude market. $60 and about 20 cents on Brent. WTI at about $57.60-ish. Tom Keene, just on the CPFC function on the Bloomberg, just to get those forecasts quickly.
Oh, excuse me, please.
Year end on Brent, your median forecast is about 57.70. 57.70 for 21. So that's the story in the forecast, Tom, and where we're priced right now. It's not a market that's bulled up, at least on the south side, looking out to next year.
Should we invest in the demand elasticity on BitDog? I mean, look at it, John.
Do you want to go there?
Popping
You go there.
44,000.
Talk to me about Bitcoin.
John, 44,000. It won't go down.
Institutional buying, I think, is absolutely vital. We've talked about that, Tom, in the last 30 minutes.
Are we going to get tick by tick, Tom? Is that what we're going to get? 44.
Like
it's down to 43.
Should be on it every tick. 44,
John, are we going to get up to
45?
80?
We're up 17%.
Are we on 80 watch?
Who upset you this morning?
Get Scott Minard on the phone.
Who upset Lisa this morning?
It's the hand, you know. It got camouflaged so right to my head.
You've got a busy week ahead of you.
I'm blinded by the lights.
Here we go.
Sing.
You had a drink last night.
It's beautiful.
Yeah.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Looking bullish this Monday morning. Good morning to you all. Biggest weekly gain going all the way back to early November on the S&P 500. 5-day winning streak could become 6. The S&P 500 up 0.4%. The Nasdaq also up 0.4%. All-time highs on the board this Monday morning. Switch up the board. The story for me, not on the equity market. We've all got used to all-time highs after all-time highs. The real story's in the bond market, isn't it? Yields up on a 10-year, 119.81. That is your new post-pandemic high on a 10-year Treasury yield. Right now, just off it at 118.77. The interesting part about today's session, the bond market coming along for the ride as well. Yields up 2 basis points there. Negative 42 still on a 10-year. Let's not lose sight of that. The appetite for higher yields is there in this market. Inflation expectations, market-based inflation expectations, getting back out to 2014 levels. It's looking toppy. Maybe for good reason. The package down in DC is huge, and that's where the debate is politically right now as well. This one, though, switch up the board, could become the political hot potato. Companies now actually actively taking cash reserves, Tom Keene, and thinking about diversifying them into Bitcoin. Tesla, Elon Musk, thinking about and doing just that. Bitcoin this morning up by 16.67%. Tom, the bull case is simple. Institutional buy-in.
Yes.
Volatility rolls over. You get a little bit more transactions there. A little bit more buy-in once again for Bitcoin. The bear case, Tom, you know it well. It is very, very simple. It won't take a lot to crash this.
But John, very important. I think, John, we got to stay on this. It's so important. That bear case is when do the governments blink?
I think that's the story, Tom. I think you nailed it. You and I were talking about it in the commercial break. One press release. That's all it'll take.
Yeah.
One government, one press release. This changes course.
On Bloomberg Radio this morning, Bob up in Deluxebury, Massachusetts, getting off the Tom Brady win. He says, Tom, I told you to buy Bitcoin at 4,000, which is unfortunately true. Let's go to Serious Economic Matters. Ethan Harris with Bank of America running all of their economic research. Ethan, I like how you and Michelle Meyer do the math. 4% of GDP plus 9% of GDP is a Larry Summers impulse of 13% of GDP. Is that too much?
Well, it's unprecedented. I mean, if you take the two packages together, the one passed in December and the one on the table now, it's as big as what we did last spring when the economy was in free fall, when the unemployment rate was 14.3%. Now the unemployment rate is only 6.3%. Just these two packages, not including all the stuff they did last year, just these two packages are much more than double what the U.S. did in the 2009 recession. So I've described this as clients as it's like the big gulp at 7-Eleven, you know, that 30-ounce bucket.
I wouldn't know about that.
Soda. Well, this is like drinking 2 of those.
Okay, well, Ethan, you know, on the big gulp, I look at the other debate, which is an open and closed economy, and that some of the economic templates of the past are much more closed economies that are not international. How does that fiscal stimulus affect America if we are much more an open economy now?
Well, I mean, when you put that kind of demand stimulus into the economy, and by the way, it's not going to show up right away. It's going to show up when we reopen the service sector and all the money that people have been holding in their bank accounts goes out into spending. But yeah, I mean, a lot of it's going to leak overseas in terms of stronger trade. It's going to provide a modest boost to global growth, but you know, we still are a relatively closed economy. It's going to be very service-focused spending, all the stuff that we've been unable to buy for a year now, that will boom, and that's mainly domestic spending. So it's going to spill over, but most of it's going to stay at home.
Ethan, how much is 2009 a correct comparison that we should be looking at, both in terms of the nature of the shock as well as how quickly the economy accelerated afterwards? In other words, a lot of people said we didn't move quickly enough, and that's why the recovery took so long. This time, we want to fix that mistake. What's your take?
Well, I think that it's correct that there wasn't enough fiscal stimulus in 2009, and we knew it at the time. We knew that 6% of GDP stimulus was inadequate given how massive the recession was. And the other thing we knew is that they gave up too early. They stopped doing additional fiscal stimulus when the unemployment rate was still over 9%, and there was no follow through at all. But I think people are looking back at that and not taking the lesson right. We're not waiting we're not sitting here at 9% unemployment. We're down to 6.3, and we haven't even felt the effects of the latest package. So this is a very strong reaction to what was a policy mistake back in 2009. The other thing I would point out is in 2009, one reason you had such a crummy recovery was because you had a banking and real estate crisis. And we know that those crises always produce weak recoveries. There's a lot of economic historians have written about this. This is different. We don't have a banking real estate crisis. We have a healthy banking and real estate sector. So once the economy gets going, you're going to have a more normal recovery with or without the stimulus. So the 2009 analogy sounds great as a talking point, but when you look at the details of it, it's hard to justify, it seems like an overreaction to that historic experience.
So are you saying, Ethan, that you think that the high asset prices that the Fed is allowing to continue actually help them achieve their goal of lower employment and higher inflation?
Well, I mean, you've got both the Fed and fiscal authorities with their pedal to the metal. It's like you've got two accelerators and no brake. So that's going to be very stimulus to capital markets. I think the danger here is not in the immediate future, but more, at what point do we kind of say, okay, now we need to apply some braking here. We're starting to get a little bit of inflation in the system. How do the markets adapt?
Yeah.
If the Fed starts hiking. I think it makes more sense to go slower, I think.
Ethan, over the last year, there's been a huge conversation about...
Okay, ladies and gentlemen, as you can see, we closed position on euro at 120.26.5. Okay, well done, all of you guys who follow this trade. We made a trade in how long? We started, let's say, 1 o'clock. We sold short and we closed position in half an hour with profit. Okay, speak to you later, guys. Check our webinar that will be held on Wednesday at 2300 hours. And if you want to join, if you want to get a strategy, please join. Otherwise, you can keep following the trades, and see how we make profit.
Performance at the low end without overheating the economy. I don't think you address inequality by creating a huge boom that eventually creates inflation. I think that that's not a lasting solution. The solution has to be education and redistributive tax policies. And we all can agree or disagree on that from a political point of view. But those are the tools for the task, not massive monetary and fiscal stimulus.
So, Ethan, from your perspective, then, it sounds like that you would be in the camp of Larry Summers on the composition of this program that's been put together down in D.C.
Yeah, I agree that they're pushing a little too hard here. I think that I'd love to see what the economy looks like 2 quarters from now when we're reopened and people have been vaccinated, service sector's coming back. And then you can figure out whether you've really done enough or not.